All right, so part two then, how did countries finance their development? And the answer is oftentimes through what you see on the slide here, and that's through what we call FDI, which stands for foreign direct investment, which is investment made from a foreign company to the economy of another country. Um, that's basically the way it works. A company invests in another in another country. Generally, that's going to be by essentially setting up maybe some sort of industrial plant there or some sort of manufacturing plant there. They're investing in that country because they're hoping that it'll pay off by putting big money into the development of maybe a manufacturing facility there. That means jobs for the locals, so on and so forth. That said, though, as you can tell from the map, FDI does not flow equally around the world. In fact, only about one third of FDI went to a developing country in 2015, I think was the latest statistic I looked at. And also, FDI doesn't evenly get distributed to LDCs. About one third uh, of FDI destined for LDCs went to China alone. And then the other third was kind of distributed between Brazil, Russia, Singapore, and Mexico. Um, the major sources of FDI tend to be transnational corporations. We've talked about these before, right? These big, multinational conglomerates. Um, about let's see, was it 2/5 of the largest transnational corporations had headquarters in the United States in 2015, and 2/5 in Western Europe is the data that I have. And so, whoops, sorry about that. What just happened here? So sorry. That's the data I have. So, and realistically speaking, those transnational corporations in the United States and in Western Europe, um, that's like 4/5 of them, really make up most of your foreign direct investment around the world. Now, of course, a lot of times countries aren't going to have the ability to attract big transnational corporations in order to develop themselves. So what happens a lot of times is that less developed countries have to borrow money to build new infrastructure, hoping that that infrastructure would attract business in, attract industry in eventually. And so that infrastructure could be hydroelectric dams, electric transmission lines, flood protection systems, water supplies, roads, hotels, you name it. Well, where do they borrow the money from to actually get the infrastructure going? Well, the two major lenders that are out there are international lending organizations that are controlled by either the World Bank or what's called the IMF, the International Monetary Fund, um, which together lend out about $50 billion a year to LDCs for development. Now, the way the World Bank works and the way the International Monetary Fund works is a little bit different. The World Bank mainly loans money to finance reforming public administration, largely to finance the development of financial institutions like banks and to build infrastructure. That's what the World Bank generally is going to loan out money for. The IMF mainly loans out money to countries that are having a hard time paying on their debt. Yeah. So sometimes you end up in debt to the World Bank and other major financial institutions, and then you got to get more loans out from the International Monetary Fund to help you pay off those debts. That's oftentimes the way this works. So why do it then? Well, the theory behind borrowing money to build infrastructure is that, again, new roads and dams will make conditions more favorable for domestic and foreign businesses to open up and expand, right? That this would actually attract business in. The problem is that many of the new infrastructure projects that you see around the world are realistically expensive failures. Um, More developed countries have become more cautious in recent years in granting loans to LDCs. LDCs judged likely to repay debts generally are going to receive more of the loans at lower rates of interest. LDCs that are considered to be riskier ventures are going to see basically higher interest rates if they get a loan at all. And so many developing countries have been unable to repay the interest on their loans, let alone the principal. The principal is the money that you're borrowing. The interest is the amount of money you have to pay to actually borrow that money. Well, what that leads to for a lot of developing countries is that their debt ends up exceeding the amount of the income that they actually have coming in. And so this becomes a real problem because now they have to get help with their debt. Now they have to beg to get their debt canceled, or at least portions of their debt canceled, because their debt exceeds their income. Essentially, start going through the bankruptcy process if you start thinking in terms of personal finance. So how does that work? Well, in exchange for canceling or refinancing debts, a lot of times international lending agencies like the World Bank, like the International Monetary Fund, require LDCs to adopt what are called structural adjustment programs, which are basically economic policies that create conditions encouraging international trade, like the raising of taxes, the reducing of government spending, controlling of inflation, selling publicly owned utility companies to private corporations, charging citizens more for services. We generally call these austerity measures. Austerity measures are basically, sure, we'll cancel some of your debt, but you've got to cut these government programs and you've got to raise taxes, right? So basically, citizens of these countries sometimes end up paying out more for less as far as services go, just so their country can get out of some serious debt issues. And so critics of this system kind of charge that poverty oftentimes worsens under structural adjustment programs for reasons I think you can do the math on. By placing a priority on reducing government spending, there are going to be cuts in healthcare and cuts in other social services that benefit the poor. And so essentially, structural reforms allegedly punish Earth's poorest people for actions that they didn't commit, or at least that tends to be the overall criticism of it all. Yeah. So at the end of the day, you can kind of begin to understand why the world ends up kind of divided between a small core and a much larger periphery. Yeah. International development is difficult. International development through industrialization is difficult. Getting the financing is hard to do that. Being actually able to pay back those loans, even harder sometimes, right? And so that's why, the latest movement tends to be towards more sustainable development, like the development programs that you guys saw through the United Nations Millennium Development Goals that we talked about a couple of weeks ago, right? Because this is indeed a very, very challenging and sometimes financially unforgiving system. Yeah. Well, realistically speaking, all of this action in terms of industry and even the service sector of development oftentimes takes place right in the country's cities, right? And so as a result, urban geography ends up being very, very much tied to this unit as well. And so we will talk about how cities sort of function as the main economic driver of development in the final part of our unit starting on Wednesday. But before that, Tuesday, tomorrow, quiz. So see you for that. That concludes the lesson for today. Best way to study for quiz is just to look over your notes since we started talking about industrialization, because that's what that's going to be about, and maybe a couple of development questions mixed in there as well. We'll see. All right. So that's it for today, and we'll see you online for quiz tomorrow.